Great. So, firstly, thank you everyone so much for attending the fifth session in this year's series in Advanced Political Economy, hosted in collaboration between SOAS, the New School, the Forum for Real Economic Emancipation, and supported by the General Federation of Trade Unions. My name is Karthik Manickam. I'm a PhD student in the economics department at the New School and a research associate at the Schwartz Center for Economic Policy Analysis, and I will be chairing today's session. So today's session talks about a particularly timely concern, welfare regimes and capitalism, housing and pension. We're building on previous conversations on inflation and austerity to look at the hegemonic role of welfare regimes under capitalism and focusing particularly on housing and pensions, and looking at how the privatization and individualization of these necessities have enriched capital and become major channels for profit making and accumulation. We have two very eminent and very excellent speakers today. We will be structuring this as follows. We'll have about 15 minutes or thereabouts for each presentation, and then be going into an open discussion thereafter and followed up with questions and answers. There should be a question and answer chat box that you can enter your questions into, which we'll be monitoring to facilitate conversation. So without further ado, let me introduce our first speaker, Professor Manuel Aalbers. Professor Manuel Aalbers is Professor of Human Geography at KU Leuven, where he leads a research group on the intersection of real estate, finance, and state. He takes a political economy approach to studying the effects of big processes like financialization and neoliberalization on cities and housing markets across the globe, and has published on redlining and exclusion, the privatization of social housing, neighborhood decline, and gentrification. He's also the author of Place, Exclusion, and Mortgage Markets, and the Financialization of Housing, as well as associate editor of the Encyclopedia of Urban Studies. Professor Manuel.
Thank you very much for that introduction. Let me just share my slides. 1 second. To say allow. I think you can see my slides now. Yeah, okay, good. Then I'm gonna maximize my slides, but that means I won't be seeing any chat or anything else. So if there's anything, just speak up and let me know if there's something wrong or if you can't hear me or if I'm going too quick. So thanks a lot for this invite. Happy to talk here today. I will be talking mostly about housing, a little bit about pensions, because the two topics are actually very much related. I do this based on a variety of papers that I've written over the past couple of years, together with a variety of co-authors. So not everything that I'm saying is just my single work. Sometimes at the bottom there's a reference if you want to look up more about a particular slide. Of course, I'm also relying on work of other people here, which I will also mention. And then one of the slides also I will present is based on a new research project called Equal House, which is a European Union sponsored research project where we look at equality and very much inequality in housing systems across the EU and the UK. So this is a picture that comes from a report from the former UN rapporteur, Lailani Farah. You may have seen her documentary Push about housing prices, housing rents going up around the globe. And afterwards, she started an NGO called The Shift. And she asked me if there were kind of these data available where you could really show how housing prices are going up around the world. So I put her in the right direction. Where can you find this kind of data? And then she made these graphs, or probably had some of her people made these graphs for I think 12 different countries. So I just took a screenshot of 4 of them because all 12 might be hard to see. So I picked one where you had next to each other 2 Western countries, in this case New Zealand and Germany, and 2 global South countries, Chile and Mexico. And what is quite remarkable here is that all those graphs actually are exactly the same years, 2050 to 2020. And also, these are nominal values, and they use the same vertical axis also, so they go up to 150. Very often when you see these kind of comparisons, either the years are a little bit different or the index numbers are different. But what you actually see here is that all of these countries have a more or less stable level of income, average wages, the dotted line. In some countries it goes up a bit, in some countries it's almost flat, it goes up and goes down a little bit, but the differences are relatively small. And then there's the other line going up quite steeply, and those are housing prices. If we would make a similar picture for rent, we would see in many countries, in many cities also, we would see a similar picture. So what I'm arguing is not that these four countries are unique. What I'm saying is that this is happening across the world. House prices rise. Very often rents do too, although rents are a bit more complicated. But income levels remain relatively stable. And my argument is this happens in most cities and most countries around the globe. I think if you would actually do a proper study on this and try to get data for as many cities and countries as possible, my hypothesis would be that for more than 95% of the countries in the world, you would find something like this. So very often people explain these stories and they say like, oh, but there's something particular in New Zealand. Oh, there's something particular in Chile. You need to learn this about my country to understand these. And I'm not saying that these things are not important. I think it is important to understand those local and national stories. But if something like this is going on in almost all countries and all cities around the globe, there's also something more going on than just a story about New Zealand or a story about Chile. So I will tell you in the next 10, 12 minutes or so part of the story. I can't do the whole story. Um, but in the title, there was also a connection how we would connect pensions and housing to welfare regimes, to welfare states, to political economy, kind of ideas about different kind of states. So I refer very briefly here to the ideas of the Swedish sociologist Asping Anderson. He probably had the most famous typology of states, the typology of welfare states that he developed, well, now 35 years ago or so. And he came up with three types we know quite well: the liberal welfare states, the corporatist welfare states, and the social democratic welfare states. Typically these days, we also talk about familial or Mediterranean welfare states, but Asping Anderson himself actually was quite skeptical about adding a fourth type within Europe. He said this fourth type is a subcategory of the second. And after years of people saying this is a specific type, he said like, well, okay then, but I really think it's just a subtype. Then, of course, over time, people started to talk about other types: post-socialist regimes in Central and Eastern Europe, East Asian welfare regimes, and then people were discussing hybrid models. The Netherlands, where I'm from originally, although now based in Belgium, is often seen as a hybrid model between the corporatist model and the social democratic model. Also, there's been discussions: how static are these models? How dynamic are they? The UK is interesting here because when Asping Anderson wrote about this and said this liberal model, now I'll think of the UK next to the US. But he actually said the UK is not a very clear cut. It seems to be sort of in the liberal model, but it still has some characteristics of the social democratic model. Well, now 35 years later, probably most people would agree the UK is very much in the liberal model. But then again, if we try to apply this to housing, and many, many housing scholars have tried to do this, it actually doesn't work so well. And why is this? Well, Asping Anderson developed this model based on three pillars of the welfare state. The first three you see here: social security, healthcare, and education. And based on studying how this is organized in many different countries, he came up with the types that we saw here. But he didn't look at housing. He actually, at some point, says quite specifically, housing is actually quite difficult to deal with. It doesn't map so well on other welfare state models. There was a Norwegian sociologist who called housing the wobbly pillar of the welfare state. And that's also because very often it's not covered as much by welfare states as other parts of the housing market. If we think of the Scandinavian countries, some of them do a lot of social housing, but some don't. Some of them, like Norway, are actually very much focused on home ownership and on mortgage markets, even though otherwise they look quite similar to other Nordic countries. So in that sense, the model of Asping Anderson doesn't work so well. And there's been many discussions over the years how to do this differently, how to come up with different models. Here we see a picture from a report from Housing Europe, which is basically the umbrella organization, or if you will, the lobby organization of social housing providers in Europe. This is a picture from a few years ago, so the data may have changed a little bit. And it shows how much social housing there's in Europe. And you see some patterns, but you also see quite some things that are difficult to interpret if you think of these welfare state models. The UK, 18% is actually not that low, much higher than a lot of other countries here. Higher than even Finland, for instance, which is known, as one of the most expansive real welfare states. Then if you look in sort of Eastern Europe, you see very low percentages of social housing. Southern Europe, the same. And then, yeah, the Netherlands is very high, 32%, higher than the Scandinavian countries. France is still relatively high. Austria is, but they're still in the same group as the UK. So it's very hard to see these welfare state models here. It's very similar if we would look at home ownership models. And this is a graph from a report we've just sent off yesterday. So we're not even sure yet if it's coming out still this year or next year. This is part of this Equal House project that I mentioned before. And what we try to do here is to come up with a different typology for housing systems. I'm not going to explain that whole typology here, but what is interesting to look at the key on the top right here, we came up with 5 different groups, and even then there's a few countries, 3 countries that are still hard to map. So this is all the EU countries plus the UK that we try to map here. And then you see, actually, even if you do 5 types, it's still very difficult to speak of significant types within the UK. But if you look, for instance, at this deep market integration, the purple model here, we see that at the very top of the graph. We see 3 countries that, normally speaking, would have been in different welfare state models: the Netherlands, Denmark, and the UK. These are, in a way, the most financialized housing markets within Europe. At the bottom right, we see limited mortgage development. These are typically countries in Central and Eastern Europe, countries with very high home ownership rates, but very small mortgage markets for specific reasons that I won't discuss now. But not all the Central and East European countries are in that group. So also that makes it quite different. The red scenarios are also very interesting. Boom and bust. Spain is the one that really is striking here, going up and then going down, because what we did here, we followed 3 different years. So you see really the trajectories. Typically, very often when you see these graphs, you just see a dot on a graph. What we try to do is have 3 data points. Each data point is an average of 4 or 5 years. So you see the development since 2008 up to the most recent statistics. And then you see actually not just a dot, but how there's a trajectory of countries, and then you can compare trajectories rather than just comparing where countries are in a particular moment of time. So even though, as I was showing before, there is this general picture, at the same time, we have a picture that is entirely different. So yes, we need an explanation that addresses both of these things, I would say. But to go back to some of the similarities, I think this is a very interesting graph. This is not a graph I made myself. This is from a report by Jorda and colleagues, 2014, so a few years ago. And what they did is for 17 OECD countries, so 17 rich countries, North America and Western Europe, they looked at the ratio of bank lending to the size of the economy, so to GDP. And what you basically see here, the blue line, non-mortgage lending. So all the lending that banks do that is not mortgages. So lending to governments, lending to big corporations, lending to mom and pop stores, credit card debt, car loans, student loans, everything is in here except mortgages. And you see, of course, that line goes up. First World War doesn't have much of an effect. Second World War has a massive effect. It takes a number of decades before we're back at the level from before the crisis of the 1930s. And the line then in the end goes up and down a little bit, it goes up a little bit more. But then you look at the line of mortgage lending. And first you see the 2 lines are sort of tracing each other. They're going up almost at the same gradient. First World War then has a big impact on mortgages. Second World War too, but not as much as on non-mortgage lending. Actually, the years of the Second World War, for the first time in history, for a few years, you have more mortgage lending than non-mortgage lending. There's probably an interesting PhD in economic history that should be written about that, maybe even compared to the First World War, when you see a very different effect. And then again, you see the 2 lines going up at the same gradient, and then something starts to happen in the mid-1980s. All of a sudden, the red line starts to go up much steeper, and by the mid to late 1990s, the red line crosses the blue line. So this doesn't mean that in all of those 17 countries, there is now more mortgage lending than non-mortgage lending, but if you take a weighted average of those 17 countries, there is. The paper and the report by Jordan and colleagues also have graphs for individual countries. For the UK, for instance, you can really see 1 year after the election of Margaret Thatcher, you see that red line go up. For other countries, for the ones that I know a little bit, 5 or 6 countries, I try to see, can you trace really political shifts from left to right? It's not so easy. The only one in which you can really see that is 1 year after the election of Margaret Thatcher. But then Labour comes in and the red line just keeps going up and even goes steeper. So you have once this shift in the UK, and then in a way it doesn't stop anymore. If we would make the same graph now for middle income countries in the global south, so not the poorest countries, but large parts of Latin America, the Middle East, but also parts of East and Southeast Asia, you will now see that those are the countries where, since the global financial crisis of 15 years ago, you now see the big increase in mortgage lending. In some Western countries, this has stabilized. In some, it's still increasing a bit. but it's really in those middle income countries where you see the massive increase of mortgage lending at a much lower absolute level than in the West. So it's not really catching up yet. But in terms of the growth of the market within, sort of the national context is really quite stunning as well. I don't have a graph showing that for a whole range of countries. I hope someone else would make that, and then I will put it in my next presentation. So, but what this graph shows is that banks are in the business of lending on real estate. Everything else they do is secondary. So people often say like, oh, but this financialization of the economy, that's happening everywhere. It's happening to the pharmaceutical industry. It's true. It's happening in education. That's true. It's happening in the car industry. All true. But housing in a way is more important, partially because actually the numbers show that housing is bigger, and of course also because housing is a human need. So I would say financialization of food, housing, and maybe a few other things like education, healthcare are really more important than some other things. But then housing is also a bigger thing, partially because for most households, housing is the biggest thing they will ever invest in. Individuals buying one home is their biggest investment over life. So I'll try to speed up now, go a bit quicker to the next slides. I'm not sure how I'm doing on time, but I think I probably have about 5 minutes left. So what I'm showing here is what happens with some of the financialization of rental housing. And this is based on a study we did on Germany. Germany had a massive privatization. More houses were privatized in Germany in about 10 years than the right to buy in the UK over 30 or 40 years. So often the reference point internationally is the right to buy. And I referenced Margaret Thatcher myself earlier, but actually what happened in Germany is much more striking. So what we see in 97, all of these housing associations that we see to the left are publicly owned or were non-profits, sort of at an arm's length of the state. So that's what I put in light blue here. Then from the late 1990 onwards, regulation changes and it becomes possible to privatize entire housing associations. So not like in the UK, council housing being sold by the unit, but actually here entire housing associations privatized and sold to investors. So in white, we see a range of different investors, typically financial investors, but they're different kinds of investors. So I won't discuss them. What we see in green here is private equity and hedge funds coming in. And they are typically based either in the city of London or in Wall Street or anywhere sort of in the London or New York metropolitan area. They may be dealing with global capital, but they organize this global capital through the main two global cities. And their business model is in a way quite simple. You buy low, you sell high. These organizations have no interest in investing in housing in the long term. They think affordable housing is undervalued, so they buy it cheap and they sell it high. This is in a way the most pure or the most narrow definition of speculation. Then what we see in purple here is a new wave that follows on the green one. You see in two cases, the green one doesn't happen first. It goes without sort of that green phase of private equity and hedge funds in between. The purple ones are also investors in housing, also private organizations, but they are listed real estate funds. So they're often discussed as if they are the same thing. Oh, it's private equity and it's real estate investment trust, but these are very different organizations because the business model of these organizations is fundamentally different. Whereas the ones in green make money by buying low and selling high, as I said, the ones in purple, of course, if they can buy low, they will, and if they can sell high, they will, but their main business model is charging people rent. Also, the ones in green can invest in anything, but what they typically invest in is something that is undervalued, but it could be any industry on earth. If you are a real estate investment trust, you can only invest in real estate. And if you do offices, you only do offices. If you do residential, you only do residential. So these are a very different kind of beasts. They're also there to make profit, but they make profit in a quite different way, really by making sure they get enough rent in. And why is this important? Well, for many reasons, but one of it is that a lot of pension fund money goes into this. So here I'm just showing the Dutch institutional investors. So these are pension funds and insurance companies. And we did data every 10 years just to show like how is the investment portfolio growing of these investors. The Netherlands is a small country, but the third largest pension fund in the world is actually Dutch, ABP. So a small economy, but in terms of institutional investment, the Netherlands is one of the bigger countries on earth. So we see basically a doubling of the investment portfolio every 10 years, which is nice if you have a Dutch pension. But here we see quite a different picture. and I won't discuss the whole picture, but try to look at the bar with the little dots. This is money that pension funds put into real estate, not by buying real estate, but putting their money basically in what we see here as the purple funds. So real estate investment trust and other listed real estate funds. And what you see there is that in 1982, those funds barely existed. And by 2012, they are investing a lot of their money in these funds. So this is what typically happens. We talk a lot about the super rich investing in housing, and yes, that happens. And if you're in particular neighborhoods in London, that is really significant. But in most countries, the biggest investors in terms of volume are actually the pension funds. But the pension funds buy up a lot of housing, not directly, but through funds. They also buy up a lot of mortgage security. So the reselling of mortgages that was also at the root of the global financial crisis. So this is a very important connection between housing and pensions. If you are enjoying a pension or you're saving for a pension, have one in the future, I think there's a more than 9 out of 10 chance that your pension fund has put their money in these kind of funds that you see here in purple. I have the German example here also because this is a really big market in Germany. It doesn't mean they're German pension funds that put their money in here. We looked at it for some of these funds. They're listed, so you can find the biggest shareholders. A lot of them are those funds that then put, again, money in there. And behind those funds, again, are other pension funds. So that's a significant picture there. Here, we looked at the two biggest markets for residential real estate. So this is basically typically rental flats. Some of them are single family homes. And the two markets on earth for this are the US and Germany. So you've seen them mixed here. And basically you see here the market capitalization between 2000 and 2020. And you really see there's a small impact of the global financial crisis, 2007, 2008. But the real growth is actually not before the crisis, but afterwards. So people think like, oh, the link between real estate and finance was at the root, you could say, of the global financial crisis of 15 years ago. Actually, more than 15 years by now. But actually, that connection has been developed much more since than it was before the crisis. So this is my last proper slide. After that, just an end slide. Why should we care about the financialization of housing? The financialization of housing is driven by the demand for financial products rather than the demand for housing. Very often these pension funds and also other investors will say, policymakers will often also say, oh, but it's great, we need investment in housing. That's true, but these practices focus mostly on the existing housing stock rather than on new construction. Although this is beginning to change to some extent, there's now some investment in new construction. But if investors buy up existing housing, of course, this doesn't add any affordable housing. A lot of pension funds say like, oh, we're so great, we invest in affordable housing. No, what they actually do is they put money in existing affordable housing, but then they price it up because after their investments, they want to get a higher return on investment. So the rents go up further. So what they actually do is they make affordable housing less affordable over time. So this additional supply of finance often does not result in an additional supply of housing. Instead, it results in inflating, that's another word for rising, housing prices and rents. And this leads to a disconnect between housing prices and rents on the one hand and income on the other, as we've seen at the beginning of my presentation. Affordability declines, and to some extent, we may see displacement of vulnerable groups. What is also important, this is not something that the market does and the state is a bystander. Actually, these processes are to a large extent enabled by the state. These real estate investment trusts, like the purple ones I showed you for Germany, where the pension funds have their money in, this is only possible if regulation has been introduced at the federal or national level. Similar securitization, this reselling of mortgages, is only possible if this has been regulated at the national or the federal level. So we need to do something about it, and I'm sure there's going to be some questions about that. So I skipped that slide, also because I don't have time to do that anymore. But I just want to end with this one single statement that housing, or shelter in other words, is a human need and a human right, and we should therefore treat it as such first, rather than primarily as an asset. Thank you very much, and sorry for going over time.
Thank you so much, Manuel. Before we move on to Hwanhee, there was a clarifying question in the chat, if you could answer it in the question and answer. Basically clarifying like liberal in the context of the classification you mentioned, is that referring to neoliberal policies in those states? In the typology, this
I
one?
would
Yeah.
say in this typology, you might see neoliberal policies everywhere. It's liberal state welfare states in the sense of welfare being mostly left to the market, the government being a regulator of that market, but the government intervening less directly. Whereas in the second, there's more direct intervention, and in the third, there's significantly more intervention to keep it a little bit sort of on one dimension, the explanation.
Okay, thank you so much. That was an incredible presentation, and I'm sure there'll be lots. I know I have a lot to ask when we get to the question and answer session. But first, we have another excellent presentation by Hwanhee Bay. Hwanhee is an economics PhD candidate at SOAS University of London and Knowledge Transfer Partnership Associate for SOAS and GFTU, funded by Innovate UK. As part of her role, she develops and delivers educational courses on political economy for trade unions. Her research interests are financialization, housing, pensions, welfare, and political economy. So, Hwanhee, I'll take it to you.
Thank you. 1 second, let me highlight myself. Alrighty, I'm being the Zoom host as well as a. All right. There we go. Hi everyone, I'm Hwanhee. You may have seen me multiple times already, but it feels quite different to be here as a speaker. Yeah, I'm quite, Manuel's presentation was really interesting. There was so much to unpack and like a lot of points that kind of connect to the points that I want to talk about. So we decided to split the topic. So Manuel spoke more on housing, and I will focus on pensions and its role in the welfare regime, which has frankly like broken down in many ways. And yeah, it's interesting. Pensions is an interesting one. I think a lot of people find it like one of the most boring topics, especially like if you're not close to retirement right now. And I've developed this speech actually like years ago when I did a teach out when the UCU, the University College Union here in the UK was striking in 2021. And the fight was largely about pension cuts and the slogans were everywhere. We've got like 35% cuts to our pensions. And I thought, I'll delve into how exactly that's happening. Like through what mechanism are we losing 35% of our pensions, right? And like when I asked around, it seemed that not many people actually understood how that was happening, right? And I think that kind of encapsulates a lot of the stories that's happening to our pensions, like what pension funds are doing, but pensions in general, it's really complex, kind of hard to understand, and therefore I think it hides a lot of the sort of mechanisms through which like capitalism like perpetuates itself and the financialization and so on and so forth. And I'm not just talking about what the pension funds are investing in. I'm trying to talk today more directly about how it's impacting us. And so before I get into like the nitty-gritty details, I want to start first by asking a quite fundamental question. What is pension? Why do we need it? And who should pay for it, right? And pensions are inherently a capitalist institution. I'm not saying it as like, oh, capitalism is to blame for everything. Like, no, really, because with capitalism, there have been two sort of very major developments that happened. First of all, self-subsistence has gone out the door. Like before capitalism, like under feudalism, for example, as peasants, you work a couple days of the week, let's say 3 days of the week for your feudal lord, and then remaining 3 days, if you have some day off, 3 days of the week for yourself, right? So during these 3 days that you work for yourself, like whatever you produce in these 3 days is yours, right? That's the basis for self-subsistence. Whereas under capitalism, the whole economy became market-based. So what happens is that it's called commodification. What that means is that when during your working hours, whatever you produce within these hours, the outputs belong to your employer, the capitalist. because the means of productions were the employers, right? What you get as a worker instead is a pre-agreed amount, which is the wage or salary, right? And what you then have to do is to take this money, go to the market, and then purchase the things that you need to sustain your life, right? And another development was the fact that there were a lot of technological developments happened under capitalism, and that meant that people started to live longer and longer. And the continuous increase in life expectancy, combined with the eradication of self-assistance, began to bring about some problems of old age. By early 1900s, employers started to notice that their workplaces are full of old workers who are too old to function as fast or as efficiently as they used to like 10, 20 years ago. And they couldn't simply get rid of them, right? And remember, the jobs back then were mostly blue collar jobs, like very manual, like hard work and like physical work. And they couldn't just get rid of them because what are the workers going to eat afterwards, right? It's not like they can go back to the farm and start producing their own food, right? So actually, the private sector, the employers began to offer pensions as an incentive to retire to their workers. The deal was that during your working years, you put aside a chunk of your salary and as employer, will match or double whatever percentage it is. Like will also put aside some amount of money. And when you retire, when you finish your working life, then we'll pay you a certain amount of money each month, like salary, right? So in this sense, pensions are workers' deferred pay. I think this notion needs to be really clear. It's our deferred pay. And this development seemed like a win-win for everybody. The workers, the workers could retire and enjoy their senior years, and the younger generation got more job opportunities, and the employers could enjoy higher productivity. And the trade unions also very much welcomed this development because they believed it was good for their wage negotiation because there would be less elderly men who would work for substandard wages. And this this trend continued, and by the 1950s, it kind of became the very basic entitlement. Pensions became the basic entitlement that everyone would expect from their employer. And remember, like the 50s and 60s, this was the time, the day for the working class. And the working class, and the trade unions began to demand more and more radical things. They began to demand more control over their workplaces and even for a wider economy in general. And the capitalist ruling class, the state, were completely frightened. And one of the demands that they could adopt, they could sort of give into, was universal old age pension that's not means tested, because the pension as it began was tied to your employment, right? And who gets left out in the deal if pensions are purely occupational based? It's the people who are in unpaid work. So a lot of women who work, domestic labor, reproductive labor, were excluded from this pension deal, and they were forced to be financially dependent on men. And increasingly more and more the informal casualized work, like undocumented migrant laborers, got excluded. And these days, frankly, just a lot of young generation, because a lot of the works are just completely casual and independent contractors, all that sorts. So by the 60s, a lot of the states in Western Europe and the wealthy countries, they began to offer the states began to offer universal age, what counts as universal, that's quite like debatable and complicated, but by now, like most states had some sort of like base. It's not that they replaced the occupational pensions, it was added as the very basic need. It was, in other words, the working class began to see this as a basic need, like as Manuel mentioned about housing. Pension became to be noticed as what the state must provide to its citizens, right? And it was now we kind of like go into I want to kind of now talk about like different ways the pensions are funded, how they're financed, right? Like how do you finance this? Um, Most sort of like basic rule of thumb is that a lot of the state pensions are so-called pay as you go. What that means is that the current elderly population's retirement income, the pension that the state gives out, is funded mostly by taxation. What kind of tax depends on the country. It can be payroll tax only, or also it can be like, some all sorts of like other taxes as well. But most of the state pensions are pay as you go because the state has the power to sort of tax. And the social contract is that as practically the current working population is funding the current elderly's retirement income, the promise is that through the state power, the future generation will do the same for me, right? Um, and this was the norm, and then like occupational pension scheme, like so what's tied to your employer was kind of complementary. But then as we all know, like the economy, which was booming, population was increasing in the 50s and 60s, productivity was increasing, but then like 70s onwards, you start to see stagflations and so on and so forth. And everyone knows the main culprit of everything, neoliberalism enters, right? And there has been a trend in even in pensions. And I think this is something that went very under noticed compared to like other types of privatization. Um, Probably because it's so complex and like people don't often think about it until they are really close to retirement. But basically the IMF, the World Bank, institutions like them, they started to really push for the Anglo-Saxon model, which are largely based on individual savings, prudence, individual responsibility, and like financial literacy and things like that, as opposed to the continental European model of more basic universal provision. And the quite seminal paper, the Averting the Old Age Crisis, in 1994 was produced by the World Bank, basically highlighting that this pay-as-you-go scheme, basically like, paying out retirement incomes for the elderly now by taxing the current working workforce is not sustainable, they said, the World Bank said, because the population is not increasing as fast, or it's going to decline at some point, and the productivities aren't increasing as much, and this they even basically called it a Ponzi scheme. And so the in the UK and the US, Australia, like in the Anglo-Saxon countries, like basically majority of the pensions are completely privatized and individualized. And I'm going to explain what this means, what it means for a pension to be individualized. Um, so before I was talking about like, how to finance pensions, and the pay-as-you-go by taxing, that's only available to the state. Whereas what the employers were doing, when they started the pensions, it's called funded pension, because you have a pension pot, like, the money goes into this pot and obviously it gets invested. Now the pensions, so the states began to like reduce the universal pensions, the old age pensions, and then bring in like means test and so on and so forth, and basically started to like push individuals to save for their own retirement as an individual. And the main method was basically mandating, I think, except for a few countries, like mandating employers to offer some sort of pension scheme, and um, and providing the tax benefits for pension savings. And so currently, when I did the research for this speech, like in the UK, I realized that just how much privilege I had as part of a university superannuation scheme, which is called USS. That was the kind of going back to the beginning of the story of the pension dispute. And that dispute actually like sums up the whole trend that has been happening. So there are two ways where the pension determines how much you will get paid after retirement. There is defined benefit and there are defined contributions. These are the two major, and then of course there are hybrids, but you can ignore them. They sound complicated, but it's very simple. Defined means fixed. Benefit is the money that you get after retirement. Contribution is the amount you put aside during your working years in the every paycheck. So defined benefit was the norm when the pension first came about, when the employers promised the pensions to the workers. Defined benefit means that you may contribute like different amounts, like the amount that you put aside during your working years may slightly go up and down during the years as they re-evaluate the value of the pension pot. But what you will get after retirement is fixed, and that is the employer's responsibility, right? And it's their liability on the employer's balance sheet. So they absolutely hated this scheme, and especially since the Thatcher and Blair and all these like reforms, it's the states made it really easy for employers to switch their pension schemes from defined benefits to defined contribution. What defined contribution is that you put aside a fixed amount each month during your working years. However, what you get after your retirement depends on the investment performance of your pension fund or of your pension pot, right? This completely individualizes the risk, and the risk is now completely on the employee, the workers, rather than the employers. And the figures I've seen was quite shocking. Like in the UK currently, um, like almost 90%, like around 90%, like 90 of the workers are covered by DC defined contribution. In other words, all the risk is theirs. Like, what they will get after retirement completely depends on the financial performance of their pension pots and the pension funds. And the defined benefits scheme basically died out completely, except for very few sectors like the university lecturers or the NHS or teachers' pensions, public servants' pensions, things like that. And I've noticed that this has been the trend in majority of the countries, especially in Anglo-Saxon countries. Uh, like the 401k in the US is also completely employer based. It's not even sectoral like my pension scheme. Like it's completely employer based, completely individual defined contribution, i.e. all the risks is on the worker. And very few defined benefit schemes and are like industry-wide, sectoral, or like state funded. These only apply to like very small portion of the workforce. And I want to kind of finish by pointing out this funny thing that I've come across while researching pensions. In the 1970s, Peter Drucker, who is a really big figure in like business management field, like it's a very, very big name. He wrote a book called The Unseen Revolution, I think, basically arguing that how that the society pension fund socialism has arrived to the US. That was his argument, as pension funds became so big and they've become the major shareholders of almost all existing companies on the US stock market. He basically argued because pensions are workers and they own the shares of the companies, it's socialism. That's what he argued. Um, and he was scared of it. But it's really funny, I think, because who here feels like they actually have control over where their pensions are invested, you know? And I think it's really evident in the way that, like, for example, there's been like numerous protests for Palestine and the BDS. There's been so much demand from below from workers to divest, but that has barely been happening. And I think it really shows that rather than leading to socialism, pension funds are just further alienating us from our own deferred pay. Thank you.
Thank you so much, Hwanhee. That was incredibly fascinating, potentially alarming, and lots to think about from this presentation as well as the previous presentation. So we'll be now moving into the question and answer session. I'm going to abuse my position as a chair to ask a few questions to begin and to start the discussion going before we go to some of the questions in the chat. We have quite a few that are starting to come through. So one thought that immediately comes to my mind when listening to both presentations is how pensions manifest themselves both at a systemic structural level, for example, through the pension funds, as well as at the individual level through what you were talking about in terms of how pensions have made things individualized. And so I wanted to get a sense of from both of you about what the implications are for someone that's like aging now and trying to think about these things through a little bit. Where do they start piecing together how much individualization has affected their ability to like navigate these systems that you talked about, and like how does one sort of go about trying to understand this broad issue as a whole?
I think one thing to mention first is that yes, everything is individualized, but a lot of people put their money in an index fund or in an exchange traded fund. So that basically means that rather than making individual choices, which is sort of the neoliberal ideal, people pick their own stocks and spend time doing this. Most people say like, yes, I want to do this individually, but I don't know anything about this and I don't have the time to do this. So I put my money in an index fund, and that index fund, what it does, it traces an index, as the name suggests. So that might be all companies over a certain capitalization in the market, and they put money in there. Or you have specific index funds that put their money in real estate. They also exist. But most people will pick a very general one. And that means the general fund will invest in all kinds of industries, also industries that you probably don't want to support, companies that you don't want to support. So that's the same problem if you have a collective pension fund, right? A collective pension fund, they might also put their money in things you don't understand. But then collectively, as workers, you could put some what you can say, you can influence those decisions. You have a say in most countries. Workers have a partial say at least about what happens with their pension funds through labor organizations, through other means, sometimes to directly to the firm, depending where the pension fund is organized. So there's something you can do about it at that level if you don't have an individual pension fund. If you do have an individual pension fund, I would say don't blindly put it into an index fund. Because, yeah, if you don't know what they put their money in, that means they also put their money in all kinds of shitty things. So, yeah, you probably want to consider that twice. And I'm sure I don't have an individual pension fund, so I never looked into those. That's not something that's common in Belgium or in the Netherlands. Most of them are run for an entire sector or for part of a sector, typically not for one company. So I've never taken the individual route, but I'm sure there are specific funds that put their money on all kinds of different things, but they would raise sustainable funds, or they would not put their money in the financial sector, or not in the arms industry, or not in companies that deal with Israel. That could be a concern for other people as well. So there's all kinds of different concerns, ethical concerns people might have. I'm just mentioning a few. I think the most common one typically are now sustainability issues. And I know funds exist for this. I'm not sure to what extent this is targeted at pensioners to do these individual funds, but luckily we have someone who might know about this.
All right. Let me clarify your question before I answer. So your question was like, if I'm close to retirement, like what's the advice? Advice, and what can
It's
we do?
less that, but it's more that like you've talked about how pensions are presented as this individualized responsibility while having social structural implications.
Yeah.
And that tension between these two things is something that's difficult for an individual to navigate. Um, and so what are your thoughts about on that?
I see. Yeah, where Manuel pointed out, like individual or otherwise, it may still, yeah, be kind of similar. Yeah, I totally get that. Ah, I think I don't know if I have like really good ideas on that, but you know what? I actually when I was like reading, actually this is a book I kind of like read like a Bible on pension research. It's banking on death or investing on in life, but. Uh, so historically, I'm like really surprised by the demands that the trade unions used to make. And like I think it was like 50s or the 60s that the unions were demanding that like the pension funds be used for like housing associations, like building associations in within the local community. And and that kind of ties the housing and pension together, right? The problem now, the fact that a lot of pension funds are invested in housing is is kind of like yeah you it's making affordable homes less affordable, as Manuel said, right? So we want more affordable homes, and pension funds are huge, and like we have the money, and I think we can do that rather than like letting the big property management companies to just demolish social housing and then build more and more high-rise flats and like luxury mansions. That's one way, and yeah, and like it's really important to note that pension funds, like yeah, as much as we hate this where they are currently invested, as our demands be more radical, it's also a source where we can, where we should head to, like where we should invest in the long term as well.
That seems like a great response to a lot of like the abundance discussion around that's like sort of growing in the US. And so my next question would be that do you see the implications of so for example, like if we were to move towards a situation in which workers are more in direct control of their pension systems by shifting back towards a DB system, for example, but at the same time also retaining ownership of the pension fund in some capacity. Do you see the limit? Do you see the ability to, do you see that as being beneficial to the larger goal or the larger intention of regaining some degree of control over the means of production as well? Or do you find that to be something that needs to be sort of looked at simultaneously? What I mean is that like in the earlier discussion that you talked about where pension funds could be used to like to be allocated towards social housing, in a situation where like the process of development of housing is still not owned or like there's not a strong degree of ownership by worker collectives, that there may be limits to that kind of approach. I don't know if what I'm asking makes sense necessarily.
Um, yeah, I think so. So like you're asking like basically, is it a good thing that the trade union has or like workers has some control of their own pension funds, and how concretely that can be implemented?
I think what I'm asking more is that enough? Or is
Mm.
there more that needs to be done to make the pension system work in our favor?
To me, I think like this. I first of all think like pension wise. reinstating the defined benefit schemes. And like, again, there's more details, like, it used to be tied to people's final pay, but then they also trend has been that it's now tied to average pay, and so on and so forth. But I think first we need to start by reinstating defined benefit pensions to wider society, not just limited to a couple of like sectors. And the I think the state's universal pension coverage must be much higher than just like 50% and then rely on the occupational scheme. Um, and yeah, I think that's of course like within capitalism, and it still like has limits. And but yeah, I see that as a starting point, first of all. Yeah. And
Manuel, do you have any thoughts?
yeah,
I
sorry.
don't think I don't think I have much to add to this. I would assume also it was a starting point, but I don't know so well the pension fund part of this. The funding, yes, but not the policy side so much.
Yeah, I just kind of wanted to quickly add, and also like in terms of the state pension as well, like they're saying that, oh, it's not sustainable, but I think our like minds has also been limited. Like, why does it only have to be payroll tax that we pay, fund pensions? It can be wealth tax, right? And again, from this book, if I remember correctly, Tony Benn in the 80s argued that the revenue from the North Sea oil must be used to pay out pensions to the workers. Why can't, like, we need to think more like the taxation must be different, and we need to kind of get out of the mindset of everything. The high tax just means like high income tax, like things like that. Yeah, that's another starting point, I think. But yeah, I don't have like a whole answer.
And my final question before opening up to the many questions that we have under the chat is the classic question of what is to be done in terms of everything that we've discussed. Of talking about pensions, like regaining direct benefits as like a starting point. But Hwanhee, as you mentioned, there are potential limits to focusing on the conceptualization of pensions as deferred wages, rather potentially leaving out people who are unable to work, for example, and also the potential for that approach pitting one class of worker or one section or one industry against another, which often happens in the way that unions have developed, at least in the US in the recent past. So my open question to both of you is like, what are the implications of both your presentations to um, the ongoing process of organizing labor in response to these concerns?
Do you want to go first, Manuel, or?
I could, and I'll keep it short. In a way, I'll refer to something I said earlier. I think in the case where there's still pension funds organized at either the firm level or the sector level, they should really get back that influence that in many cases they used to have much earlier. They should be a louder voice, and they shouldn't take no for an answer. And no these days often comes in the form like, yes, but we're trying to get you the highest return on investment. That sounds very attractive, but I think that's not a sufficient answer, and I don't think it's always true.
Yeah, I think I've already kind of said all my points on like what is to be done. Yeah, but I just want to point out that like it shows a strong correlation with the working class power, like the union density, like the coverage of collective bargaining, and the direct correlation to the pensions declining and worse individualization of it.
Thanks so much. We'll start going through some of the questions in the chat. And we'll start with this very important question by Professor Yavuz, which is both presentations seem to be centered around the core, or call it global north or Western developed countries, mostly Europe, with occasional touch on the periphery, um, where the story has unfolded quite possibly very differently. Despite the historical, social, institutional, etc., differences between the core and periphery, can we say the latest phase of capitalism has homogenized the global globe in terms of housing, pensions, and even healthcare system?
I would not say homogenized. I don't think there's a homogenization taking place. Very often people talk about globalization. They also understand this in terms of homogenization, but I would say globalization is a process like capitalism that exploits existing differences and erases some of the differences in that process and creates new differences and distinctions within that process. And I think the same is happening here. I think it's true we talked more about core countries. Also, not all countries in the global south obviously have pension fund systems. But I think an increasing number of them do, or some of them have quasi-pension fund systems, where something is not officially a pension system, but it might be organized through a provident fund. Brazil, for instance, has a massive provident fund, which is a federal fund which takes in employer and employee contributions and is one of the biggest investment vehicles in Latin America. So funds like that exist, and they also tend to invest in real estate. This particular fund in Brazil also happens to be not only the largest quasi-pension fund in the country, it's also the largest real estate investor in the country, and its subsidiary is the largest mortgage lender in the country. So in a way, I would say what we see in Brazil is an organization of real estate, finance, pensions, even more tightly knit together than we actually see in many Western countries. I'm not saying that's a typical scenario for the global South, but I think in some middle income countries we see something like this, although the Brazilian case might be still quite an extreme example. It's a very clear example in that case, though. So as I was saying, like a lot of these developments we see now popping up in middle income countries, not necessarily in less developed countries. But it is something at a much lower level. So I don't think it's going to erase these differences between global north and global south. What we also saw, especially in the global financial crisis, that capital was being moved from the global north to the global south, but of course it went to select global south locations. So in that sense, that didn't mean that those places became more similar to the global north, but that they started to see similar types of capitalist development. But then they interact with existing levels there. They interact with informal economies. They interact with the fact that they tend to be lower labor cost countries. So that gives all kinds of different patterns rather than sort of recreating the global north and the global south. But we do see the process of financialization there. We do see processes there where pensions get more tied to financial markets. I think those things are true without necessarily making them the same. It's a very long answer, and it's even still a very partial answer.
Hwanhee?
I hope my answer is not longer. Yeah, actually, my primary research focus area is South Korea, where I'm from. I don't know if it counts as global South still, but that question aside, one thing I noticed is that the because we're talking about the welfare regime or like the welfare state or the demise of it. The thing is, in the global South, there hasn't really existed such a thing as welfare state because it's a consequence of developed capitalism and the working class fighting back to the various problems of capitalism being in advanced stage. So it kind of like I yeah, like welfare system that we know as in the West is kind of like an accumulation of like very ad hoc like measures that put together and then kind of like worked out as like, oh, okay, these are the minimum things that we expect the state to provide. And the yeah, I must say that the South Korea's National Pension Fund, it's a national occupational scheme, but it's run by the state. And it certainly has the similar tendency of like investing less in bonds and more in equity and moreover like the other category, which are real estate investment trusts and the various derivatives instruments. And I don't know too much about pensions in other countries, but actually on housing, something I noticed is that um, something called pre-sale basically is like buyers start paying money to the developer before the building's completed, right? That's a really popular scheme in South Korea, and I realized that it's being promoted in the global South, like countries like Kenya, Nigeria. I've seen lots and lots of papers, people arguing that this is the way, it's a way to mitigate the circumstance of like we lack the capital, there is not enough capital in the country, so the buyers can like get discount by paying early rather than 3 years later, assuming that the house price will go up. the buyers can benefit, but also it's a social risk sharing model between the developers and housing, and then increase the housing supply ratio by, sharing the risks. And it's an incredible narrative of like individualizing the social provision of, very basic needs, like just basically passing the burden and the risks onto individuals. So I think like maybe it's not a rollback of the state. That's quite a different pattern to the West from the West, but the direction we are going, I would say, is kind of similar. Yeah, maybe the details are different, of course. Yeah, that's my opinion.
Thanks so much. Yeah, I can say in the case of India, both of like the discussions that both of you have raised are incredibly relevant. The interaction between like global financial capital and informal markets in India and informal labor, the implementation of like privatized neoliberal individualized pension systems for the large scale gig economy and the impact that it has on individuals not being nearly what was promised, and the scope of labor actions being reduced as a result, and so on. So a lot of these discussions are very relevant.